Thanks, Sarah. That's like 2 days in a row I've managed to unmute myself, the first go. So yeah, the rest of the week's going to be an absolute disaster, isn't it? Thank you, Sarah, and welcome to everybody to today's session. It's always, well, we've had some really interesting and good responses to the online sneak peeks that we did for this session. So I know we're going to get a good one today, but it's always interesting, I think, when we do sessions which help businesses kind of look at something core, and as core as kind of cash is king. I know, because I'm going to have to disappear on you today, that we have our board meeting, and finances and trying to make sense of it at the moment is just incredibly difficult. And we're trying to look at, you know, what will the end of the year turn out like? What's next year going to look like? How do we plan based on what we thought we were going to do? You know, it's just a difficult time, I think, for everybody, whether it's your kind of what you're doing with your teams, what you're trying to do to innovate your business, and this is going to be a really good session. So Sarah said a short update, and that made me laugh because she can't even see me and I'm sitting down, but I am pretty short. The Chamber has been doing a lot of projects, and hope that many of you have been catching up with those. But things that are really kind of taking our focus at the moment are some internal things. So, you know, as we're kind of going to talk about today, you definitely have to continue to invest in your own business, and we are looking at a big digital investment program for the Chamber at the moment. Very fortunately, I think we had pre-planned this from, you know, last year. We put it on pause in the first quarter of this year. We took stock of where we were at and said, you know, we have to do this. It's really important. I think, like everybody does, probably underestimated how much time and how long it would take, and the impact it's going to make is really going to be pretty phenomenal. But this is not just a new website for our business. This is a new CRM system, a new way of talking to our customers and engaging with people, and really thinking hard about what we do and how we future-proof our business. So we've been doing that. We're also taking the opportunity to kind of give ourselves a brand refresh and look at how we talk about our business and what we do in that space. We have had a new team member join us this quarter, a new graduate apprentice, and that, again, that's, you know, something kind of new for us. We are a UK government Kickstart gateway organisation, which means that we're acting for a number of other businesses that want to take advantage of those Kickstart placements. And so far we have put in over 100 jobs into the job portal, and we're now at the stage of wrestling through the process, trying to make sure we get the grant funding and the kind of the grant offer for all of those placements, so that employers can start getting some unemployed young people into their businesses. And you know, we've got a good number of placements also expressed of interest for the future. So really proud to be engaged in that project. We were also funded by Scotland's Thames Partnership to work on 2 very specific buy local programmes. So in Dundee, we have launched a Love Dundee local website and app, which is going to use the Hunger platform to give a kind of one consolidated space for a number of businesses to, I mean, essentially operate a digital high street. And then in Angus, we're working with Angus Council on a My Angus by Angus project, which is about that local spend and encouraging us to look at those high streets that, you know, are now on our doorstep, that we've got much more time to go and kind of look at and make sure that our Christmas presents are coming from all of these local shops and local employers and local businesses that are really at the heart of what we do. So yeah, lots going on. Not such a short welcome from me, but massive thank you to the team at Johnston Carmichael for taking the time to come and kind of talk to us today. We've got Robert and we've got Andrew that are going to talk us through things from their angle, and then Sarah's going to look after the Q&A while I disappear off to our board meeting. But thank you so much for coming along today. I really do appreciate it. If you're watching this on a YouTube channel, then who even knew that YouTube was going to be such a thing when we all started to lock down in March? But the Chamber and Sarah has done an enormous amount of work in kind of getting digital content there, and it's there on our YouTube channel for everybody to go back and look at. So hope you've enjoyed that, and I'm going to get out of the way and hand over to Robert now.
Thanks very much, Alison.
Thank you.
Good morning, all. And again, thanks to the Dundee and Angus Chamber of Commerce for giving us this opportunity. So today, there's myself, Robert, and Andrew, my colleague, and we're going to talk to you about two very separate things. I'm going to start off by talking to you about capital allowances. The whole idea about cash is king. It's about the intrinsic tax reliefs that lie within property. And I'm going to basically just have a chat through with you today about what you can do in terms of your property, whether you're building or buying. So if we can just move on to the next slide. So I'm going to tell you about who we are, just to give you an idea of the mix of who we are. I'm going to talk about capital allowances, and if you don't know anything, I'm going to keep it pretty basic. I'm not going to do anything complicated. It's not rocket science, to be honest with you. If it was, I would definitely not be involved in it. It's pretty straightforward stuff. I'm going to talk a bit about property transactions. That's just a couple of slides. I think the key thing is to show you some case studies. That's really important. They let you see how they actually work. And some of them are quite big, but capital allowances is applicable to the smallest of properties. And then a little brief summary as to gather everything together. So if we could just move on to the next slide, Andrew. So here we are. Here's the team. Yes, I am the Brad Pitt lookalike second from left, as you can see there. And we're a mixed bunch of people. There's myself, and the gentleman from the second from right is my colleague and line manager. That's Michael. So Michael's a chartered surveyor. I'm a chartered construction manager and chartered building engineer. And the other three folks there, that's Rachel and Vicky and Inderbeer, are all corporate tax accountants. Because essentially capital allowances requires a combined series of specialisms and expertise. We've got quite a few years of experience. We cover all commercial property. We're big into renewables. Our background is with engineering, project management and quantity surveying practices. And our accountancy colleagues a lot of them come from the Big Four. We do everything from owner-managed businesses, big UK property funds. We do small dental practices in small towns. We do absolutely everything. And we're primarily based in Scotland, but we do sort of jobs all over the United Kingdom. Thanks, Andrew. So a quick reminder. So it is a property-based tax relief. That's a fundamental thing. And it reduces your liability to income or corporation tax. It allows you to pay less tax. And it's all about plant and machinery, but now also includes parts of a building that you weren't allowed to claim before. And I'll talk about that on a slide further on. So it's all to do with new builds. It's if you build your small office block, put a small shed up. It's to do with extensions and alterations. If you refurbish a property, if you fit it out, and if you purchase or buy a property. I think the key thing there is, second from bottom, is it's relevant to all commercial property. So it's not really applicable to residential property. You can't claim capital allowance your conservatory that you've just fitted at the side of your house. That's essentially, it doesn't work that way. As I say, it's also applicable to any renewables integrated into a building or a standalone renewables. And I think the key thing there is that the level of allowances really depends on the type of building. If you could imagine a small sort of industrial type shed, it doesn't have an awful lot in it. Some lights, maybe a small bit of power and a small office at the end. There might not be an awful lot of allowances in there, but a data center is a very different picture. Think of all the cooling and computer equipment, lights, that sort of thing. So it just depends on the type of building. Something that I should mention that's really quite important is that I think the three key factors for claiming capital allowances is that you need to be a UK taxpayer, you need to have an interest in the land, i.e. you have to have a lease or a freehold on the property, and you've got to have incurred the expenditure. Thanks, Andrew. So what kind of allowances are out there? What's available? Well, we've got that list of basic allowances that we see that's part of the regime at the moment. These are all set out under the legislation, the Capital Allowances Act 2001. The actual piece of legislation itself, I would highly recommend if you suffer from insomnia. It's an absolutely fantastic read, riveting. gives Mills and Boon a run for its money any day. So we've got a series of allowances that are applicable under the legislation. You can see that we've got the special rate pool, we've got a main rate pool, structures and buildings allowances, just recently introduced in the last couple of years. That's going to be very, very applicable. Enhanced capital allowances, contribution allowances, research and development allowances. I'm hoping Andrew's going to be speaking a bit more about that when we get into his section, so I'm not going to steal his thunder at the moment. We've got revenue deductions, land remediation, and short life asset identification. Now, that's quite an extensive list, but what does it actually mean? Well, if you think, we go right back to the top, the special rate pool, what essentially it means is that if you spend money on a new heating system, then the cost of that can go into your special rate pool. And it basically means that if you your new heating system costs you £1,000 and you draw it down at 6% per annum off that £1,000. And I'm going to show you an example of that in a slide just further on. Main rate pool is things that are not set out, as you will see in the next slide, in a defined list. Structures and buildings. For years, the industry has been saying that, you know, people are spending a lot of money on foundations and frames and external walls and windows, but they can't actually claim any form of tax relief for it. Initially it was brought in at 2% back in October, and it's now, in the last budget, was brought up to 3%, and it's on a straight line. So you'll basically just take 3% of it every year. Enhanced capital allowances was withdrawn in March this year. Fantastic allowance. It really promoted energy efficiency. It was a big part of the climate change agenda, and the capital allowances community, to be quite honest, was a bit amazed when they actually stopped it. It just seemed to go against the grain of policy that was coming out of government and trying to get people to go green. And it had a list of items like lighting and heating systems and air conditioning that you could claim at 100%. We found big office investors were really keen on it. I worked on a number of jobs, one of which we will look at in our case studies that looked at ECAs quite significantly, and that we were involved at design stage. There's contribution allowances. So if you are a landlord and, for instance, you contribute to a tenant's fit out, you can claim some of the allowances based on your contribution. R&Ds, I'll leave to Andrew. Revenue deductions for repairs and maintenance. That's a really important one. That's where we identify where there's a repair taking place, because it's pretty important that you would maybe want to take a 100% revenue deduction as opposed to a 6% special rate pool. So they're quite important. Land remediation relief is a very big one. I've just recently finished a job through in the west of Scotland for a house builder. There's massive land remediation there, and as you can see, it's at 150%. So for every £1 that you spend, you get £1.50 back in tax relief. And it's not just about remediating land. A key feature of it is that it's about asbestos removal. So as long as you weren't the polluter and put the asbestos in the first place, that's a very lucrative relief. And then finally, the short and long life asset identification. That's when we find the revenue starting to take an interest in, where you may have something that has an economic life that's greater than 25 years or something that's a bit less. You really need to be identifying that separately in order for to benefit from the reliefs. Okay, thanks, Andrew. So previously I mentioned the 6% pool and the 18% pool. So there's our 6% special rate pool. This is set out in legislation, and it's what they call the integral features of a building. It's electrical systems, it's cold and hot water, any form of space or water heating, cooling, purification. If you have a floor or that's used as part of your cooling or heating system, then that's an integral feature. The usual one: lifts, escalators, your moving walkways, any external solar shading, and thermal insulation to an existing building. So if you put thermal insulation into a building when you're fitting it out, then you can claim 6% special rate pool. I can actually think of a building in Dundee that I worked on that we did that with, and that was the DC Thomson building. Their offices that were refurbished in the last couple of years, they had a lot of insulation put into the walls. It was an older building. We directed them and said to them, that's one of the things you really need to be thinking about in terms of capital allowances. And then there's your main pool at 18%, and it's not a defined list. So that's very much a process, a case law there. But the standard ones that we look at are all those items listed there. And it can go on. The case law surrounding capital allowances can be quite complex. And it's one of the things that we look to when if we've got anything obscure. I recently visited a farm where I saw a cow go up to a pillar and rub its backside against the wall, and a brush turned and brushed its backside. And I thought, where do I claim that in terms of capital allowances? So that went in as a main pool 18% item. It was a fixture and fitting. I don't think the cow would have called it that, but it's definitely what we would call it. Thanks, Andrew. So how do they work? So I'll take this nice and steady because I'll be honest with you, it can be complicated for me sometimes when you look at it. Let's take an example of an existing small office building. It's over 2 floors, and you can see the gross internal floor area there is that footage, just over 19,000 foot. So they decide to do some alterations and refurbishments and a bit of M&E, and the cost of everything comes in at 2.5 million. So this is an example. This is just to give you an idea. So we would be asked to carry out the exercise. So we look at the exercise, we get the bills of quantities, we get the final account, we look at all the variations. For us, doing the capital allowances exercise is very much about the construction process. And we will reconcile to the accounts, but we start with looking at what it actually cost to do this alteration and refurbishment. So out of the 2.5 million, we identified 2.25 million. So there's £250,000 of non-qualifying. And from that, it splits across the table as you see it there. So if we look at 18% MP, main pool, we can see there's £625,000 of main pool. At the 6% special rate pool, SRP, we see 1,125,000, and the 3% structures and buildings is at 500,000. So the total allowances is 2,250,000. And then it's just a case of basically a reducing balance of 2 of them and a straight line on 1 of them. The 2 reducing balances is the MP, main pool, and special rate pool, and the 3% straight line is the structures and buildings. And you see there, you just draw it down each year, and there's a balance at the end. And you just keep drawing down and drawing down and drawing down and using your allowances. Now you can see over to the right, the total columns, you can see your allowances for each year. So in year 1, it's £195,000 is the level of allowances that you can use. So if you make £200,000 of profit that the taxman and wonderful HMRC comes along and goes, you need to give us £200,000. That's what your liability is. That's what's that's what your taxable liability is. You can come along and go, well, actually, I've got 195. So I'm going to take that off my 200,000. That means I've only got £5,000 it's liable for tax. So it basically reduces the amount that you have to pay tax on. So if you think of that £195,000 and you're a 19% taxpayer, then that means your cash flow saving is £37,000 over time. Okay, so that's how pretty much it works. Each year you just go down, you just draw down, you just draw your allowances down. You can see with the 3% special structures and buildings allowances that it's just a straight line. It's just 15 grand every year because it's 33 and a third years. So at the 3%. And essentially, when you get to year 5, those are the types of levels of allowances that you've claimed down at the bottom there, and what your cash flow saving for that particular project would be. So as you can see, your cash flow saving at 19% corporate tax rate is £145,000. So it's worthwhile. And this, as I said before, this could be a small dental practice. It could be, a small retail outlet, a shop. It doesn't have to be a big office building or a big factory. Thanks, Andrew. So structures and buildings allowances was introduced on the 30th of October 2018, and it only applies to contracts entered into after this date. That's a key thing. That's a really key thing that you have to think about. We changed there in April 2020, and the period that the relief will qualify over is 33 and a third years. Okay. It looks at the elements of a building or a structure that does incur high costs. So if you can imagine, even if you put up a small shed, when I say a shed, I mean a small industrial building, not your garden shed. you're going to have to lay foundations and put a frame and put all sorts of walls on it. And the legislation before the 30th of October 2018 had been for a number of years that you couldn't claim your allowances on this. They had some old allowances that were kind of went out of basically they were taken away in 2011. Industrial buildings allowance and agricultural allowances and these sorts of things were all taken away. So this is a step to try and reintroduce these, because they're very, very costly items. All those items there, your steel frames, internal walls, that sorts of things. You know, there's some people in the audience will know what I'm talking about. You know, when you look at these, you know, things like internal partitions, all sorts of things like that, it can be quite costly. So now they're saying that you can claim some forms of allowances, and they can add a significant value. You might think to yourself, well, it's only 3%, but what happens if it's 3% on 100 grand? That's a lot of money. 3% on 10 grand is a lot of money. And right now, cash is what we're chasing. We're trying to reduce those outflows out of the business. So what you need to do to capture that, your maximum level of allowances, is all about information with SBAs. So it is about dates, the date, the contract or the contracts, because you may have a series of contracts where the works were entered into, and the date that the building or the structure was brought into use. If you're going to gather information, those things or those two dates are the key things that you should really be looking for. What can you claim? Well, as usual with HMRC, there's no guidance there. There's no published list as to what or does not qualify. So that's where possibly your best line of approach is to find somebody that knows what's in the building, how they put these buildings up. Thanks, Andrew. So capital allowances, when should I think about them? And the simple answer to that is as early as possible. As early as possible, we would always say. There's decisions that when you start designing it that will influence, you know, the quantum of allowances and the type of allowances that can be claimed. A big part, one of the case studies we'll look at, is that we were called in right at the beginning because the client wanted to claim the 100% enhanced capital allowances. So we had to sit down with the M&E engineers, chat through M&E engineering talk, air conditioning systems and flow rates and all sorts of things, but also how efficient was it, that would it comply with the criteria for the enhanced capital allowances scheme, because they had set quite high levels of energy efficiency, so the installation had to meet that criteria. A key part of the process for capital allowances and claiming them is information. So if you can start at the beginning by saying to somebody, well, while you're doing this work for me, I'd like you to supply me with this information, then you're going to make it an expectation. It's going to be part of their contract administration and your contract administration. If you say to somebody when the contract's finished and they've been paid all their money and whatever else, by the way, can I have these several volumes of information? 9 times out of 10, we hear people saying, yeah, we'll try and get it to you as quick as we can. And then it's a fight to try and get that information. So if you introduce it right at the beginning, what you can therefore do is make it an expectation. It's about final account information. It's difficult to chase when all the works are complete. If you introduce it as a part of the contract, that's a thing to do. With buying or selling, you know, you're looking at early participation, because what you're looking for to do is for a capital allowances to be on the agenda. You need to carry out a due diligence process. You need to make people aware of it that might have not been aware of it. So that's really important there as well. Okay, thanks, Andrew. So very briefly, I'm going to look at property transactions. So we've got a buyer slide, as you see here, and the next one's a seller slide. So buyer slides is basically bit into 3 areas: your pre-contract, your contract stage due diligence, and your post-completion. And you can see that I'm not going to kind of read out the bullet points, but it's pretty much nice and steady. It's like your pre-contract is it have I got a capital allowances clause in there? Am I entitled to claim on this property? Are my lawyers and my property agents on board with this? Do they understand what it is I'm trying to achieve here? And then have I got an estimate of the potential allowances for my investment appraisal? So you're looking at your pre-contract stuff. Yes, this is something I really would like to do. We find it quite interesting that a lot of property transactions, when you're a buyer, you're focusing in on VAT, land and buildings transaction tax and everything else. And everybody seems to forget about capital allowances because when you buy a property, they could come with a whole load of allowances that you could inherit, but you have to be prepared to do some legwork at the beginning to make sure they come your way. So during your contract stage, you're doing all your contract wording, you're asking the seller, have they claimed any allowances? Are they willing to pass some on? That sort of thing. And you've got all your requests for information there. And then when you've finished it, you want to carry out your survey, you want to do your evaluation, and you need to prepare it in such a way that it can go into your tax comps. And then if it gets questioned, which it can do, you need to deal with your HMRC inquiries. Thanks, Andrew. So, seller, you really want to sell this property. You don't want any delays. And 9 out of 10 buyers will come and ask about capital allowances. So if you have got a property and you've got your allowances, can I hold on to them? Well, you can. You may sell the property, but you can hold on to the allowances, but you need the cooperation of the buyer, and you need to do it through a Section 198 election. And you've got 3 options. You can hold all of the unclaimed allowances with the agreement of the buyer using the Section 198 election. You can pass all the unclaimed allowances across to the buyer at the tax written down value, TWDV, or you can pass over the allowances at an agreed level. So if you've got 100 grand of allowances, you can hold on to them and get the buyer to sign your Section 198 election if they're happy with that. If you've got, or you can pass everything over, or you can split it 50-50. You might want to split it 60-40. There's no set rule to it. If the seller is not claimed or does not want to retain the allowances, you need to highlight that to the buyer, because you can't let these allowances go untouched. They can be lost. They'll just basically disappear. And everybody will lose the right to do anything then. And then if you are going to use your allowances and you've got them as a seller, put them in your sales brochure. It can make an investment more attractive. People will notice this because it is something that will come with the actual property. Thanks, Andrew. So let's look at some case studies. We've got this particular one here was the Radisson Red in Glasgow. That's just a one that we finished in the last couple of years. We were on this job for 4 years. It was a big job. It had absolutely everything in terms of allowances, main pool, special rate pool, the ECAs. As I mentioned, we were in it from the start. We went in and identified sort of the air source heat pump system. We identified a combined heat and power system on the roof. There was specialist lighting that qualified for ECAs. They were everywhere, and it required us to carry out a coordination process and make sure we had all the relevant information. Lots of short life assets with a hotel, as you can imagine. Lots of the catering equipment and all sorts of things, crockery and all sorts of things were in there. There was some land remediation relief because there were some historical concrete pile caps on the site that had to be removed, and they were expensive, so that qualified under land remediation. And there were some revenue deductions, which is quite unusual for a new build, but they had to reinstate the roadways and pavements around the hotel, and they were allowed to take a revenue deduction. So all in all, there was 49% of the expenditure was qualified for allowances. And it was all about planning. It was just about us planning absolutely everything, and just being with the client when they made decisions. We've seen it where people can go in and go, well, actually, I don't like those lights. I want those ones. And then find that instead of getting 100% ECAs, they were only getting them in 6% special rate pool. So it was quite important. So that was a really good job to work on. Thanks, Andrew. Student accommodation in Glasgow. Student accommodation is one of those that is affected. You can't claim the actual flats themselves, but you can take the common areas. It's been caught out with some of the legislation. But as you can see there, we still managed to find a chunky amount of allowances for the client. Big set of main pool, big special rate pool. It was only 9% of the expenditure, but the saving over time was £150,000 in cash. Cash is king, most definitely. And the provider for the student accommodation was quite happy with that. And, you know, having a look at the photograph, the kind of main pool items you're looking at are all things like all that, you know, the TV and all the units around it and the sofas and all sorts of things in there that can qualify for main pool. Thanks, Andrew. An industrial unit up in Aberdeen, out towards the airport. The bottom picture you can see there, that's the inside of the unit. It might look quite sparse and empty, but it's got heaters and lights, and there's 3-phase circuits going around it. And there's my favourite, there's a crane rail. I get quite excited when I see a crane rail. They're really good, quite costly, full of allowances. And then externally, you can see there's all sorts of external lighting and everything around the building. Expenditure again was about 22% of what was reviewed, and the allowance level was there, and the savings over time, £142,500. Client was very, very happy with that. Thanks, Andrew. Oh, a new organic gin and vodka distillery. Somebody has to go there, folks. I'm sorry, and it had to be me. And we do a lot of distilleries, and they are very intense in capital allowances. Very, very capital allowance intensive. As you can see, they're also a pleasure to survey as you're a plant and machinery geek like myself. There's nothing better than going around, you know, looking at all this stuff. They got some ECAs in this particular distillery because there was an element of a visitor centre and people getting shown around. They had to have some specialist lighting, and it qualified for ECAs. But all the vodka and gin sort of distillation towers there all qualified, as did virtually every piece of pipework in the place. And distilleries are quite lucrative. We're looking at 55 to 65% can qualify for capital allowances. So that's quite an important one. Thanks, Andrew. And my final one is an anaerobic digester, everybody's favourite. How to generate electricity from pig slurry. Whoever I thought there would have been money in it with that particular saying that I won't say. It's at the top there, you can see there's a pig slurry tank. This particular individual was a farmer who had a pig farm, and over in the background of the top picture, you can see some polytunnels. So it was a case of he grew raspberries and berries for one of the or a couple of the main supermarket chains. So he decided he needed to do something with his pig slurry, because obviously he could sell some of it, but it was costing him money to get rid of it. And he came up with an anaerobic digester. Now, an anaerobic digester is pretty basic, folks. Basically, he puts the slurry into that big green tank in the bottom photograph. He then grows some northern variety corn on the cob, which he mushes up, he macerates it and sticks it in. They use a big Kenwood Chef mixer and mix the whole thing up, and they heat it to 55 degrees, and it gives off methane gas, which he then collects, and he puts it through a big generator, and he generates electricity, and he sells it to the grid. So the last time I spoke to this client, I says to him, how's your anaerobic digester? He says, I don't call it that, I call it my cash cow, because it makes him quite a bit of money. He got a good feed-in tariff rate for it, and he sells it to the grid. What's interesting is that then that the engine that generates the electricity in terms of generator was, you know, obviously gets very hot. So he wrapped a water blanket around it and heated water and ran the water out to the polytunnels, which allowed him to grow a bit earlier, start his season a bit earlier and finish a bit later, because he could heat his polytunnels. And I think he says he got an extra crop out of it. So there was no waste there. 95% of it qualified for allowances. So as I say, you can see that spectrum, that whole, you know, range of levels of allowances, right from your office at 30% to your student accommodation at 9 or 10%, right through to 95%. So it just depends on what the building type is. And I say it again, it can be anything from that small shop to the dentist's practice to a nursery to a play area. So for this particular client, they were an income tax rate payer, and their cash flow saving over time was £640,000. So he was a very, very happy man. If I remember correctly, I think he says he was going away to build another one. It was that's such a good deal for him. Thanks, Andrew. Okay, just to quickly summarise before I hand over to Andrew. Capital allowances, we've seen changes in the legislation. Introduction of SBAs has really changed things. It's a real game changer in terms of when you're constructing, altering or refurbishing. Think about your allowances right at the start. Appraisal and design stage. Chat to somebody, chat to your accountant, chat to your capital allowance advisor. It's all about understanding buildings, the technologies that they use. It's about capital allowances and energy efficiency legislation. It's the days of where people could look at a set of accounts and go, right, we'll take 10% of this and 20% of that to claim for allowances has long gone. HMRC look on it really quite badly. They don't like that. You need to do a detailed review. We would recommend this. You need to optimize your position. You need to get as much cash out of this asset as possible. I use the term, you need to sweat it. You need to sweat your asset. You really need to get as much tax relief out of it as you can. It's all about working together. It's about working together with yourself, a capital allowance advisor, with your accountant. Everybody needs to work together, the contractor, whoever's doing the works for you. And more importantly, claims are possible on historical expenditure. There's no real time limit. So you need to be thinking about things in the past as well. And just to finish off there at the bottom, they are complex, but they're valuable, and there are people here that can help you in looking at this. Thanks very much for your time, folks. As you can see there, we've got some contact details. What we will do after the presentation, I'll speak to Sarah. I'm sure we can make this PowerPoint slide available to people. And all the contact details are there. But thank you very much for your time. And I'm now going to hand you over to my colleague, Andrew McMillan.
Trying to unmute myself there. Thanks very much, Robert. That was brilliant. As ever, you've given me a very difficult act to follow. I'll start off just with my content. So again, to introduce myself, folks, my name's Andrew McMillan, and I work as a senior manager as part of Johnston Carmichael's Innovation Taxes team. My presentation is going to focus on a specific type of capital allowances called research and development allowances, which, as the name suggests, is available in respect of capital spend associated with R&D activities. Like Robert, I'll start by giving you an overview of the team that I work in. I'm then going to touch on R&D tax relief, including the criteria that's got to be satisfied for a company to claim, the rates of relief available, and the costs that can be claimed for. And I'm then going to move on to research and development allowances, how they work, what expenditure qualifies, and how that's linked back into R&D tax relief. And I'll finish by chatting through a case study, which hopefully will highlight the immediate cash relief that can become available as a result of RDAs. So as I mentioned, I work as part of Johnston Carmichael's Innovation Taxes team. Our team's responsible for assisting clients across our firm in making claims for R&D tax relief, claims made under the patent box regime, and claims made under or for the creative industries relief, such as video games tax relief. The team's spread across the firm's 13 offices, and we focus exclusively on these areas of tax. And when it comes to R&D tax relief, we have a combined experience of more than 35 years. I often hear it levied at accountants that they don't have the technical expertise necessary to effectively identify activities that qualify as R&D and to evidence those to HMRC. But that can't be said about Johnston Carmichael. Our team comprises scientific and engineering expertise, as well as the tax technical, accounting, and business advisory specialists necessary to ensure that a holistic approach is taken to the preparation of every claim. As noted on the slide, the firm also sits as part of HMRC's Consultative Committee on R&D. So that means that we sit as part of a small group of advisors who consult with HMRC on their latest priorities and objectives with regards to policing of the regime, provides us with a useful forum to feedback on any consultations or proposed changes to the legislation and accompanying guidance. Our clients range from from small early stage startups to large multinationals and even listed companies, which I think highlights the kind of flexible approach that we take to assisting clients in this area. So I'm now just going to move on very quickly to give you a kind of brief overview of R&D tax relief. And the reason for that is that RDAs, which is, I guess, the main purpose of this talk, are only available in respect of capital expenditure associated with qualifying R&D activities. So R&D tax relief is a valuable tax relief designed to encourage and promote innovation by UK companies. As with the Capital Allowances legislation, the legislation for R&D tax relief is really prescriptive, but the key is that the claimant must have been undertaking work which qualifies as R&D for tax purposes. The definition of R&D for tax purposes is given in a document called the Bayes Guidelines. They state that qualifying R&D arises when an entity undertakes a project which seeks to achieve an advance in science or technology through the resolution of scientific or technological uncertainty. I appreciate that's a total mouthful. I find it easiest if you break it down into 3 separate requirements, each of which has to be satisfied for a claim to be made. So firstly, you have to have a project, so a systematic, methodical approach to something, rather than just a eureka moment where you stumble upon your advance. Secondly, what you're trying to achieve must constitute an advance on the baseline state of knowledge and capability in a field of science or technology. Now that sounds like an incredibly high bar on the face of it to get over it. But if you look at the definition given in the guidelines, it's actually very wide. It goes anywhere from pure research, which is advancing knowledge and capability in a field, through to creating a product, process, material, device or service which incorporates or represents an advance, right through to at the lower end, making an appreciable improvement to an existing product, process, material, device or service brought about through technical change. What's key to all of that is that it's measured by reference to publicly available information. So for instance, if you're undertaking a project which is seeking to develop a new piece of technology and information isn't out there in the public domain in a codified form that allows you to routinely deliver that, then it's likely that what you're doing would qualify as an advance. The final part of the test, and it's often the hardest to satisfy, is that achieving that advance must require the resolution of scientific or technological uncertainty. Now that's all measured by reference to a competent professional working in the field. So that's someone working at the forefront of the relevant area of science or technology with the requisite expertise and qualifications. So there should be challenges associated with the project such that the competent professional can't readily resolve these through, for example, review of publicly available information, the application of routine or well-established methods, etc. If you have a qualifying project, the claim will form part of a company's corporation tax return. The deadline for making a claim mirrors the corporation tax amendment window, so it's 2 years from the end of the accounting period in which the relevant activities were undertaken and the associated costs incurred. So for example, if a company incurred qualifying costs in a period ended 31st December 2018, it would have until the 31st December 2020 to make a claim. As the slide states, there's 2 different rates of R&D tax relief available. The most generous is the SME scheme, which, as the name suggests, is for small to medium-sized enterprises. So that's companies with less than 500 staff, 100 million euros turnover and 86 million euros gross balance sheet assets. The RDEC regime, which is obviously less generous, is usually applies to entities that breach those thresholds, but can apply to SMEs in certain circumstances. And that brings us on to the next bullet point. If the claimant has undertaken either contract or subsidised R&D, would have to claim under the RDEC regime in respect of the subsidised costs or projects which constitute contract R&D. I'm not going to go into these concepts in any great detail today because it would take a lot of time, but you will notice that the slide refers to a recent decision from the First Tier Tribunal. We don't get many cases when it comes to R&D tax relief going through the courts, but this was a recent one and it could well be incredibly important moving forward. It was a 56-page judgment, so again, I'm not going to go into it in any great detail as we'd need a whole separate webinar to do that. But what I think is worth saying is that it brings into question HMRC's approach to identifying contract and subsidised R&D and suggests perhaps a more restrictive approach that in some ways runs contrary to their own guidance in this area. So what I would stress, if anyone on the call today makes R&D claims, I would suggest that they reach out to their R&D advisor for further information on this and to establish what impact that's likely to have to you moving forward. If you have an eligible project, there are certain types of costs that you can claim for. So that's staffing costs, so gross salary, employers' NIC, employers' pension contributions to the extent that they're incurred in respect of their software costs. So at the moment, that means software license costs. There's a consultation going on to which will potentially see the extension of that particular category, but at the moment, it's just license costs. Consumable costs, so that's cost of materials or items consumed or transformed in the process of undertaking the R&D. Subcontractor costs, so if you engage any specialist third parties to assist with your R&D, that could potentially fall within that category. And externally provided worker costs, so that's individuals supplied to you through a third party who work under your direction, supervision or control as part of the R&D, so like agency workers essentially. So only revenue costs can be included as part of an R&D claim. The revenue capital divided is driven by the tax legal definition rather than, say, the accounting guidelines. So that can lead to situations in which development costs can be brought into account in determining the value of an intangible asset for accounting purposes, but also be revenue in nature from a tax or legal perspective. Just going a bit too far there. Determining whether capitalised development costs are capital or revenue from a tax perspective is quite complex, and it requires the consideration of a number of factors, including the cost of the project, the importance of the project, the degree of organisational change associated with the project, and any associated capital expenditure. Again, I'm not going to go into that in any great detail today, but if on consideration of those factors, costs are deemed to be capital in nature, they can't be included in a claim for R&D tax relief. Now, that can mean that costs absolutely essential to the undertaking of R&D are excluded from qualifying for R&D tax relief. And I'll give a really obvious example. You might be building a lab where R&D is going to be undertaken, and the cost of building that lab will not qualify as a revenue cost, and as such won't be allowed to be included in your R&D claim. And that is where RDAs come in. So RDAs are a form of capital allowances available in respect of capital expenditure incurred for carrying out research and development or for providing facilities for carrying out research and development. As I said before, the definition of R&D for the purposes of RDAs is again driven by the BAY's guidelines. If spend qualifies for RDAs, the claimant gets a tax relief equal to 100% of the costs incurred in the period of addition. In addition to the really generous relief, there's also very few restrictions associated with RDAs when compared with other similar capital allowances, such as annual investment allowance. Now, if I draw it back to that of building a lab, prior to the introduction of structures and building allowances, which Robert touched on previously, there would be much of that build that wouldn't qualify for any form of tax relief. However, if that lab was built for R&D purposes, it suddenly brings in everything other than the land for 100% tax relief. So prior to structures and building allowances, it was a really, really generous and wide-reaching relief. And I'll touch on in a minute why, even despite the introduction of structures and buildings allowances, why RDA should still be considered when you're incurring any kind of capital spend. So I thought it'd be useful if I were to cover off some common queries that we get with regards to RDAs. So the first one, what if I buy a piece of equipment for use in an R&D project, and then once the project is over, use it in relation to a project which doesn't qualify as R&D for tax purposes? So the key to all of this is the business intention at the time that the expenditure is incurred. So for example, if a company were to buy a piece of machinery or kit and the intention was to use that exclusively for R&D purposes, then it would be entitled to claim 100% RDAs. If subsequently the asset were to be used for something else down the road, but that wasn't the business intention at the time that the expenditure was incurred, then there's no clawback of RDAs. The second question, what if I know from the outset that the equipment's going to be used only partly for R&D? Well, in that case, the legislation prescribes that you take a just and reasonable apportionment. So basically, if a company built a lab again, which anticipated would be used 50% for R&D purposes, then 50% of the cost could potentially be claimed for RDAs, with the rest, if appropriate, eligible for other forms of capital allowances and tax relief. The third question, I've incurred capital spend in relation to an R&D project. What are the benefits of considering RDAs over other forms of tax relief? So as I mentioned before, that there are fewer restrictions associated with RDAs when compared to other forms of tax relief, including annual investment allowance. So prior to the introduction of structures and building allowances, you may have been able to claim tax relief in respect of expenditure that wouldn't qualify for any other form of tax relief. In addition, RDAs can accelerate the reliefs available, which depending on your tax position could be advantageous. So Robert mentioned before that structures and building allowances give you 3% straight line deduction. So that's going to take you 33 years to achieve your full tax relief for any costs that qualify for that particular relief. Now, if the same cost were to be eligible to be claimed under RDAs, you'd get that 100% deduction in the first year. And that brings me on to the fourth question. So the company's made a tax loss in the relevant period. Is there any immediate benefit of claiming RDAs? So firstly, there's the obvious one. If you increase your tax loss, that increases the losses that are available to offset against other profits, whether that be for another period or via other mechanisms such as croup relief. However, in specific circumstances, I'm going to come on to this, it can also increase the cash relief, so the cash in your hand that you get as a result of making an R&D claim under the SME scheme. So I'll talk about this in the case study. So this was a recent one that we had. We were engaged to assist with an engineering company with its claim for R&D tax relief. So initially we weren't actually engaged around RDAs. The claim was being made entirely under the SME scheme. I think it's also worth noting that this claim was being prepared as part of an amended corporation tax submission, so for a previous period, and that JC weren't acting as CT agents when the original corporation tax return was prepared. The company had incurred expenditure in building a shed, which to be used exclusively for R&D purposes. This was pre-structures and building allowances, so much of the expenditure didn't attract any form of tax relief. So the company was making a claim under the SME scheme, and this had resulted in a tax loss for the period. Now, where you're making an R&D claim under the SME scheme and you've incurred a tax loss in the period, you can surrender those losses for a payable tax credit at a rate of 14.5% of the losses that you surrender. So you essentially sacrifice the potential use of losses in the future for cash in your hand. The loss that a claimant can surrender is limited to the lower of the R&D qualifying expenditure plus additional deduction, and I'll explain a bit about what that means in a minute, and the unrelieved trading loss. Now, in this instance, by claiming RDAs, not only were we able to deliver tax relief in respect of spend, which had previously been categorised as ineligible by the company's previous agent, but we were able to increase the surrenderable loss and ensure a bigger cash in hand payout for the company. So I'll just move on to the numbers because I think it's probably easier understood. So this is the company's information prior to the claim for RDAs. So they'd incurred £200,000 of spend on a shed, of which the previous agent had determined that £85,000 was qualifying for AIAs and the remaining 150 non-qualifying. It had an R&D claim of £80,000 made under the SME scheme. Now, under the SME scheme, for every pound of qualifying expenditure that you incur, you get an additional deduction equivalent to 130% of that to deduct and arriving at your tax profit or loss in the period. So in this instance, they had a deduction of 104,000. Their pre-RDA's trading loss was 105,000. So you remember I mentioned a minute ago the surrenderable loss is limited to the lower of the unrelieved trading loss. So in this case, it was 105,000, and the R&D expenditure plus additional deduction. So you'll see in this instance that the loss surrender is limited to the the unrelieved trading loss, which at a rate of 14.5% gave them a cash payment of £15,000. So this is exactly the same numbers at the top here in terms of the spend on the shed. But here, what we were able to do is, in addition to the AIA claim, the remaining 115,000 under RDAs. Now, what this did was increase the trading loss for the period. So I think it's worth noting that nothing had changed with regards to the company's R&D claim. It was still the same expenditure. They had still spent the same amount on the shed. That was historic spend. But by classifying things properly, we were able to identify additional tax relief. Now, what this did was it didn't only just increase the loss that they could utilise in the future, but it increased the loss that they were able to surrender in the short term for the repayable tax credit. So again, these numbers at the bottom here, we've got an unrelieved trading loss now of £220,000, which is more than the R&D expenditure plus additional deduction, thus meaning that we can surrender the whole 184,000, which resulted in a repayment of 26,000, so about 10,000 extra. And in addition, they have excess losses to utilise that they can now carry forward. So that highlights the benefit of RDAs, not only in getting tax relief in terms of the generation of losses or a reduction of profit, but it can, in certain circumstances, lead to cash in your hand in the short term. So just by way of summary, RDAs are obviously a generous form of capital allowances associated with R&D activities. As with any other form of capital allowances, and Robert's already mentioned this, it's best to engage at the design and planning phase. That allows for full consideration of potential tax reliefs available, thus reducing the net cost of the project to the maximum extent. I would say, and obviously I'm massively biased, but when you're considering RDAs, the best approach is to engage a firm with the requisite capital allowances, R&D, tax and accounting expertise to consider the proposed spend and potential relief. As I mentioned a second ago, RDAs can accelerate tax relief and, in certain circumstances, lead to immediate cash benefits. And, as Robert mentioned, claims are possible on historic expenditure. So that is the end of my presentation. I don't know, I'll hand back to Sarah now, and there's maybe some questions.
Thanks very much, Andrew, and thanks, Robert, as well for those presentations. There's obviously quite a lot for people to digest. Like you say, Robert, it's very very critical to businesses, to be kind of claiming back this income, but also very, very complex. And obviously having experts like yourselves to guide businesses through the process is ideal. We don't have any questions in the chat. There's obviously a lot being covered, and I'm sure once people kind of go back and think about how it would be implemented and into their organisations and possibly future projects, there may be that come from it. What I will do is I'll be putting together a survey for attendees, just with kind of general feedback on the event. So if you're able to send those slides over, I will send them on to people. This recording, as Alison said, will also be going onto our YouTube channel within the next kind of 24, 48 hours. So if you want to share it around colleagues, pass it on to contacts, then please feel free to do so. And obviously you can head back and review what Robert and Andrew have both covered. I'm conscious of time. If nobody has any questions, then I think we'll just kind of round it up there. Obviously the contact details for both Robert and Andrew are within that presentation, so please feel free to make contact with the experts direct, and I'm sure they'll be able to help and kind of guide you with any questions that you do have. So thank you very much, Robert and Andrew, for joining us. Lovely to hear from both of you. Thanks to everybody for joining the session as well this morning, and we hope to see you all soon. Thanks, guys. See you later.
Bye.